Hey, welcome everyone. Although we've seen increased market volatility the last few days on news of this new COVID variant, the stock market recovery over the last 18 months has been exceptionally strong, maybe too strong. Speculative activity in the markets clearly surged beginning last year, but there's signs that some of the most significant market excesses are washing out. That's what we're talking about today. Stick around. I saw this table bouncing around Twitter most recently. It really caught my attention. It's really the inspiration for this video. But this table obviously highlights a bunch of the story stocks from 2020 and how much things have changed here in 2021. It also reminds me of a table that I created last January when we kind of seemed to peak with the market insanity around the whole GameStop situation. Perhaps you remember that. Well, last year, this table, just a quick refresher, there were literally hundreds of unprofitable businesses that, despite not making any money, these companies experience stock price gains of 3 times, 4 times, in some cases over 10 times. So I put together this list. This is kind of the top 25 names that I identified. And I just updated this for today, our brief discussion here. You can see all the returns in last year, 2020, when this stuff just went bananas. But it's a much different story here in 2021 through kind of late November. And although the returns aren't uniformly negative, obviously by and large, I mean, you can see the red ink up there. The median return of this list of 25 companies is negative 17% so far this year. So to me, this is just classic investor behavior. People get excited about some narrative, and when you look at this list, for instance, you can see where a lot of the fervor was, basically anything having to do with e-commerce last year, biotechnology, healthcare, obviously, given the pandemic and so forth. Electric cars was hot and remains to be hot, although we've seen a pullback in some of the story stocks, if you will. But again, what happens is people pile into some sector of the market. They run prices up far beyond what the fundamentals justify. And of course, the problem with that, when you bid up assets beyond what they're really worth, on the downside, prices can fall as fast, if not faster, than they rose. Now, you might be asking yourself, how can the broader market still be so positive this year in 2021, although we're experiencing some volatility as I record this? But how can the market still be well in the black despite all the rink that I just illustrated? Well, one of the key factors driving the broader market indices is the strength in the biggest market components, or the companies that have the most weight. So, for example, if you look at this list of companies, these are the 6 top companies in the S&P 500, the Standard & Poor's 500, which of course is 500 names. The point is, these 6 companies, 6, I'm doing 5. These 6 companies represent 25% of the market weight. So my point is, as long as this group of companies continues to show strength, it's going to be difficult for the major market indices broadly to show a lot of weakness. I just want to point out that this list of companies, the top 3 in particular, are some of the most profitable businesses in history. And that's important. My point is, although their stock prices have been very strong, perhaps they're not up 10 times. Let's just put Tesla aside for a second. But Microsoft, Apple, Google, in particular, their market prices have been very strong. There's few people that are arguing that there is froth in those stock prices in comparison to some of the names that we looked at in those prior tables. So, are the excesses of the COVID market rally washing out? Well, clearly, at the very least, some pockets of this excess are absolutely washing out. You can see that in the data. The big question is whether or not this weakness is going to spill over into the broader markets. Now look, a market downturn is always possible. But again, my view is as long as these major tech firms continue to display fundamental strength in their businesses, that's likely to continue to provide a lot of support for the broader markets because they represent such a disproportionate share. What's amazing, and I'll leave you with this today, this is on a related topic. If you look at the trailing returns of the broad market indices over the last 10 years, you're looking at about 17% of annualized returns. And that simply is unsustainable. And frankly, someone who manages money for retirees, this is one of my biggest concerns. My question for you is, what do you think stocks will do over the next 10 years on an annualized basis? And drop your comment in the comment section below so in a decade we can look back and see how good our guesses were. Look, thanks for watching today. If you're wondering, my focus is on retirement planning and investment management for individuals over 50. Look, feel free to reach out via any of these methods. Hope we'll see you next time.